Hi there and welcome to the Stock Club podcast, coming to you from the top floor of MyWallSt HQ here in Dublin, Ireland. I'm James, and with me this week is MyWallSt co-founder and chief investor Emmett Savage and our head analyst Rory Carron. Today we're talking about Beyond Meat partnering up with McDonald's, asking if Amazon is going to kill off Teladoc, and picking our favourite payments company. Right, so we'll kick off today with the same way we've kicked off the last two episodes, talking about WeWork. Rory, what has happened with Adam Newman?
Well, he's gone, is the short answer. And he came to an agreement with his biggest investor, Softbank, to step aside. He's now the non-executive chairman. They've brought in two co-CEOs, one of whom is a kind of tech veteran who worked in Amazon for years, and the other one is kind of a Newman loyalist, I suppose, is the best term for him. He was CFO for WeWork. So it'll be interesting to see how the two CEOs deal with what is a real kind of dumpster fire at this point.
Yes. But there was some very interesting news about him during the week. Did you see what he's after backing?
Go ahead.
Did you see it?
No.
He's backed a business called Selena, and it's a London-based company that provides travellers with co-working spaces, accommodation and leisure facilities. So he's after going in on a business that is basically, to my eyes, WeWork meets Airbnb.
Well, they had something along those lines. I saw part of their investor deck that was leaked where they were talking about We Live, which was basically WeWork for accommodation.
Yeah.
So yeah, I'm not surprised at all. Surely there must be some sort of non-compete clause.
You would think,
but
I'm just looking
that
here.
Sounds very.
Yeah, it's so close, but it currently has 54 locations. This company, Selena, in Latin America and Europe, with a total of more than 12,000 beds, which I guess is starter level, and it aims to offer 130,000 beds across more than 400 locations by 2023. So it's really that you go to work, live there, work there, socialise there.
Feudalism.
I'm
all for bringing that back.
Me too. Let's get some beds.
And the IPO has been pulled.
Yeah, that's the big news, really.
Yeah, that is the big news.
S1 has been officially withdrawn.
But I think what's interesting about this whole saga, I think, is that there's just so many elements of it which seem kind of like the apex of everything that was kind of going wrong in the world of investing. Really kind of highlighted by this real sort of disconnect between Silicon Valley and Wall Street. First things definitely like this kind of cult of the CEO that there's plenty of other examples of it. Newman was definitely in that zone. He was reading about him. He seemed to be this real insanely ambitious guy. When he talked about the business, he wasn't talking about starting an office rental company. He was talking about an entirely different way of people living their lives. Brought down to that one sentence in their S1, which was, we want to elevate the world's consciousness.
Yeah, written by his wife, is that right?
I wouldn't be surprised.
Yeah.
Apparently that was one of the things my Yoshi-san had a big problem with in the S1, and the two of them had a big falling out over it. But,
really?
I mean, look, I've read several interviews with people who'd met him. They all agree that he was this guy who was just absolutely brimming with confidence and optimism and really could make you believe in his vision. And so and that's really like the venture capital world, isn't it? When you pitch to venture capitalists, they're not really interested in the skill set you have. It's all about the person and the personality and the vision and can you sell this? If you were to give a venture capitalist the WeWork business model on a piece of paper, they would probably laugh you out of the room.
Yeah.
But you get this young guy who's tall and has the hair and doesn't wear shoes, and he comes in, he sells it to you and says, look, this is what we're going to do, we're going to change the world. And they all start going, okay, we better get involved with what if this guy's right? What if he is the second coming?
Just when you're saying that, I think I'm paraphrasing Scott Galloway here, but in a piece he wrote this week about Adam Newman, he said, in the tech industry, if you tell a 30-year-old guy he's Jesus, he's inclined to believe you. I thought that just kind of summed the whole situation perfectly.
But there's actually parallels. John Tyrrell and I, when we co-founded MyWallSt those years ago, about 5 years ago, he and I were sitting in a VC firm on Wall Street, and it was a room, as these things go, full of suits from Wall Street and intelligent, experienced veterans of the financial world. And we explained that we had no aspirations in MyWallSt, which at the time was called Rubycoin, to be a stockbroker, because we said it's a race to the bottom. In fact, we know this guy out in the valley, Robin Hood, and they've gone to zero. And a big debate ensued in the office, and all 15 or so of the guys in the room, and unfortunately it was an all-male meeting, all the guys in the room were of the mind that Robin Hood would never succeed. We've seen it all before. It's crazy. They don't know how it works over here on Wall Street. And John and I, stood our corner and said, well, that's fine, but we just don't have the aspiration or the core competencies or the desire to go into competition on a business that already exists, that charges nothing. And at that time, we'd spoken with the founders of Robin Hood, and we knew the guys, and on Wall Street, the old world way of thinking was prevailing. It was like, oh, we've seen it all before, and there was zero commission brokers in the past. I think Zeco was the big one, and we agreed to disagree and got on with what we've gotten on with. And it's funny, to your point, Rory, it just comes straight back around the full circuit. And I think that WeWork on this current chapter hasn't worked out the way Evan anticipated. But it will either rise again or something like it will come along.
That's one of the most interesting things about the story now, is that this company has gotten this far, not based on profit, certainly not, I don't think, based on a business model, but based on this guy. So now that he is gone, now he's not running the show, what is it going to be built on? Is it just going to be Softbank pumping in more and more money to generate growth in this business? Because that really seems like the spot that they are now stuck in, because if they don't keep growing fast, they are not going to survive very long.
Absolutely.
And you really do need to kind of now look at other SoftBank investments and think, how wrong have they been on other things?
What's the other big SoftBank investment?
Uber's the big other, and for the last kind of 5 years, Uber was kind of launching in new markets, and then SoftBank was investing in the competitor and basically pulling Uber out of it. You look at Didi Chung in China, Ola in India, Grab in Southeast Asia, and Uber was in there, and SoftBank basically went to them and said, guys, you're not going to win this fight, so take a cut off Grab or take a cut of Didi Chung, and we'll make sure there's a kind of monopoly player in that space. But now you've got Uber, which owns minority interests in what are kind of probably overvalued companies as well. So there's this whole domino effect to this SoftBank-driven valuing companies one on this. The valuations are all based on SoftBank sitting down with the CEO of the company. And
entirely.
So this is, the WeWork thing is a massive success of the public markets, because about $40 billion has been lost on paper in the last month. And that could have been registered by pension funds and retirement funds and mom and pop investors. But it came to the public markets, and the market said, nope, not having that, sorry.
And that's a big point to make, I think, as well, that we laugh at Adam Newman, that, he's not the CEO and he's kind of being slowly removed from the company. But he sold a lot of stock before this all kind of hit the fan.
Yeah, there's a part of me that feels he's kind of the scapegoat in this whole thing.
Yeah.
I think, SoftBank have a big part to play in it as well. They were the ones who were pumping money into this thing and telling everyone it was going to be the next greatest thing. It's easy then when you see those kind of Wall Street Journal profiles of them smoking marijuana and just talking about wanting to be president of the world. It's easy then to divert the attention onto him.
Yeah.
But it takes two to tango.
Yeah.
They were the ones who invested $2 billion at a $47 billion valuation. In the last year or so.
Yeah.
But I know this piece really isn't meant to be about SoftBank, but we, Roy, had a good debate a couple of years ago about adding SoftBank to our shortlist of handpicked stocks, and we had reason to pause. But what we did learn, I think, at times, how incredibly diversified they are.
Oh, hugely.
And how they have a really significant stake in so many businesses that we just can't buy at the moment. And a few names pop to mind, like there was it Boston Robotics? Was Boston Robotics the name of the business? They really have bought out some of the most impressive tech businesses we've seen over the last few years.
Yeah, no, but I think this whole WeWork thing is kind of bringing up that question of at what cost?
At what cost? This is true.
The CEO Son has said multiple times he wants big bang investments, and I think there may be a point where he has conflated the amount of money you pump into a company with the potential money you get out of a company, and that doesn't always work out. This is a prime example of that.
Absolutely.
Moving on to a company then that has successfully gone public this year, Beyond Meat. So we're starting to see Beyond Meat burgers pop up everywhere. We went for our own Beyond Meat burgers there a few weeks ago. But the big news from the last week was that McDonald's are trialing the PLT. Rory, do you want to explain what a PLT is?
Yeah, so it's a new burger that they're testing. This is now, when we talk about small testing or limited testing, this is as about as limited as it gets. They're trialing it for 12 weeks in 28 restaurants in southwestern Ontario. So I mean, that is small. There's 1,500 restaurants, McDonald's, just in Canada. This was really this was a kind of news cycle that Beyond really needed. It's a company that's trading at 52 times price to sales.
Yeah.
So, McDonald's is the white whale of this space, and for Beyond to get it would be a huge win for them. But I don't think they've got it just yet. I think investors may be celebrating a little bit too early. And to that point, there's an awful lot of change have brought in these either Beyond or the rival Impossible Burger. And if you look down the list, you see that pretty much every single one of them has leaned into those brands. So Burger King have the Impossible Whopper, Carl Jr.'s has the Beyond Famous Star, Fat Burger has the Impossible Fat Burger, Little Caesar has the Impossible Spring. Literally every single chain.
They're leveraging that brand equity.
Yeah, because it differentiates it from your usual vegetarian burger, which people typically don't like. Typically dry and not very appealing. Yeah. So all these brands have taken on the Impossible or the Beyond brand, and I thought it was quite telling that McDonald's didn't. They've launched the PLT, which is the plant lettuce tomato. It's using a Beyond patty, but they haven't called it they haven't called it the Beyond Big Mac or the McDonald's Beyond Burger. I have a funny feeling that the reason for that is they don't want to tie this product to a single supplier in Beyond. I think, if they're going to test this in a very small market, they're going to see how it sells. But McDonald's is a huge, huge contract. Whoever gets that contract is going to have some serious logistics and supply chain issues, distribution issues to contend with. And first of all, Beyond probably doesn't have the ability to do that yet. And secondly, Beyond's really expensive. Those burgers are costly. I think if you buy it in the supermarket, they're like $6 $6
or $7
which McDonald's is not going to pass on to its customers. That's not what McDonald's customers want. So I have a funny feeling the PLT is a strategic decision that lets them basically launch that burger anywhere with any supplier. So if you've got people like Tyson getting in there, in Germany, a brand that Nestle own are supplying their plant-based alternatives. So I think it's quite a slick move by McDonald's, because they've gotten the news cycle of the Beyond Burger in McDonald's, and now they've kind of got limited scope or unlimited scope to take that in whatever direction they want.
Yeah, and this is something that we kind of talked about, I think, a few episodes back, in the importance of not conflating a company with the industry. So, there's always been a lot of talk and a lot of hype around Beyond Meat and what they're doing and the impact then on the larger environment and vegetarianism and veganism and all of that. But investing in Beyond Meat doesn't necessarily mean you're investing in the best company in that industry.
Yeah, absolutely. And actually, to even Roy's point there about how it's not a done deal. Recently, Tim Hortons, the cornerstone of, I guess, Canadian fast casual dining and coffee, they also ran a trial with Beyond's Burgers. Now, I'm not too sure about Tim Hortons. I always thought they were more a coffee house than a burger house, but clearly I have to study their menu a little more closely. But they decided not to go to it. So they abandoned the burger. For what reasons, I'm not sure. And I agree with you that the whole PLT thing is such a small test in 28 locations. And unless you're Coca-Cola, I think you will not see another brand inside one of those giant chains. It doesn't make sense for them to partner with something. There's an older expression that a startup that goes into a strategic partnership with another startup has, multiplied their risk by 10. A risk multiplied by a risk on an exponential scale. But like in this one, I think that McDonald's has grown up enough to know that this really has to be lowballed. Whereas Impossible Food CEO described it as they've landed Moby Dick, I think he said, which was, I guess, to your point, Rory, really trying to maximise the news impact.
Yeah, and look, McDonald's know this industry better than anyone else. There could be a sense where they know what I kind of suspect for a while, which is that there is a novelty to this whole thing.
Yeah.
That us three went and tried it.
Yeah. I went again, by the way, with another friend to give another shot.
We're not vegetarians. We don't go down that route, but we decided to go and try it, and I think that's going to happen an awful lot in America and wherever these burgers are launched.
Yeah.
But will they still be selling them at these levels in a year or 2 years? I'm not so sure.
Yeah.
Interesting. Right, so to move on to our company we never talk about. So last week, shares in Teladoc, one of the companies in our app, fell after Amazon announced that it was launching its own pilot healthcare system that included telemedicine care called Amazon Care. So for this week's company we never talk about, we thought we'd jump a little bit more into Teladoc and look at how much of a threat Amazon really is to them.
Yeah, so it's not really a typical company we never talk about in terms of it's very much focused on this story.
Yeah.
So I'm going to start off with a story from a couple of years ago, which I think is apt, which is that on October 8th in 2015, USA Today had the following headline: Amazon launches its Etsy killer, handmade by Amazon. The following day, stock in Etsy fell 11%. The next day it fell another 6%. The next day it fell another 5%. And by February the next year, the stock had dropped 75% since the announcement. Now, obviously, that wasn't all Amazon. They missed earnings and stuff like that as well. But the company shed 3/4 of its value in 6 months following that announcement. But of course, we know handmade by Amazon didn't turn out to be an Etsy killer. In fact, if you'd bought Etsy at the low point, you'd be up 8-fold at this stage. So, that was kind of the inspiration for a daily insight we did a couple of weeks ago on when you hear these headlines, big company launches small
Something
company killer, and how a lot of the times it just doesn't work out. We've seen it with Facebook tried to push in on LinkedIn
and Match,
and well, Facebook do it pretty much everyone really. Like anything they see, they try to go after. I think Microsoft's trying it with Slack at the moment. So I mean, this kind of it timed very well with this idea of Amazon launching a Teladoc killer. If you look into it, it really seems totally overblown.
Yeah.
The business, which is called Amazon Care, is a tiny pilot program specifically for Amazon employees around the Seattle area. It's something that they obviously, Amazon's the second biggest employer in the US, so this is obviously something that they have seen as a problem that they need addressing, which is getting their employees healthcare at a cheap, affordable way and keeping them, healthy enough to be working and all this stuff. So this is a very small thing that they're trying to try. I think it's massively overblown as a threat to Teladoc. I think probably there's kind of two likely scenarios emerging from this. The first is that Amazon, in its attempt to get into the healthcare space, will buy a telemedicine company, possibly Teladoc. The other, which I think is possibly more likely, is that Amazon will end up partnering with a couple of different telemedicine companies, Teladoc definitely being one because they are the largest and broadest in terms of their network. And they'll build out a network of telemedicine vendors which they could potentially offer to Prime customers as a form of healthcare.
Yeah.
And that would be not a threat to Teladoc. That would probably be a big boon to Teladoc.
Absolutely,
I think it might even be Scott Galloway said something along the lines of, if Amazon's not after your business, you don't have a business. So when you see things like handmade by Amazon, they didn't go after Etsy because they just for the fun of it. They clearly saw a business there and decided that they wanted to try and get in on it. And a lot of the time with Amazon, I do think they're throwing X against the wall and seeing what sticks.
Yeah.
But clearly Jeff Bezos has his eyes on healthcare, and this is dipping their toe into it. That they did it with PillPack last year, the acquisition of PillPack.
Yeah, and there's also the group, I can't remember the name now, that he's involved with Warren Buffett and Jamie Dimon.
Is what they named it. Yeah, it's a joint operation between those three businesses to specifically for the employees of those businesses, but obviously could expand when they see it working, if they see it working. But one of the other things is, healthcare is a highly regulated industry, And if there's one thing Amazon wants to avoid right now, it's more regulatory scrutiny. Pulling it back a bit to Teladoc, I think that business just keeps getting better and better. Every time I look at it, revenue is up 40% year over year for the first 6 months this year. Number of patient visits grew 73%. I think the Amazon headline is all a bunch of noise, and anytime you see weakness in it, it's a good opportunity.
Absolutely.
We debated whether we should introduce a new feature called. Well, I mean, I thought it was a good idea. Now, granted, I did come up with it, but so the overused acronym FANG, the FANG bites you.
FAANG.
Yeah, Facebook, Amazon, Apple, Netflix, and Google. Although Google's now called Alphabet, thank you. So it should be FAN. But will FAN ruin your business? And maybe, we can talk about the fangs of death in a future episode.
Stay tuned for that.
Yeah.
So just to talk
I'm getting a lukewarm kind of reception here in the studio.
I love it.
Yes, brilliant.
So I just want to mention some of the new stuff in the MyWallSt app at the moment. We have October's stock of the month live in the app on Monday. It's a company that's leading the disruption of one of the most prohibitively expensive parts of the US economy. Rory, I won't ask you to give a teaser.
Yeah.
So you can check that out on Monday. We're also adding a brand new stock to the app the week after that, joining our list of stocks that has returned an overall average of 51% to date, easily beating the S&P 500. The last thing I want to remind you of is that we're now 5 weeks away from the InPerson event in New York City. If you like the Stock Club podcast, you'll definitely want to be at in person. It's a one-day live event on November 8th where you'll hear Emmett talk about what it took for him to beat the market 3 times over every single year for 2 decades. He'll then walk you through exactly how you can do it too, and you'll walk away with strategies, ideas and proven investing tactics from the day. Emmett, we recently had our in-person event here in Dublin. How did that go?
It was great. It sold out. I was absolutely in my element, and I think I'm pretty certain everyone who was there left totally charged and excited, and the feedback we got was rapturous. And I truly am happiest when I'm imparting what little I've learned in this life of mine. And the thing about stock investing is it is an absolute passion of mine, and when you have a passion, you don't stop doing it at 5 o'clock. I stock invest in my mind 24/7 and have done for a long time. And what I really, really believe in is explaining things as simply as possible, because every concept can be brought down to a very simple set of rules. And while I think it was Warren who said that, if stock investing was easy, every librarian would be a millionaire. It might have been Peter Lynch, was it? But that is a trivialization, I think, of something that's actually true. You don't need to dedicate yourself as a career to beat this S&P 500. You just need to follow a roadmap, and InPerson lays out that roadmap, and I'm delighted to do it, and I'm very excited about the forthcoming event in New York.
So that's November 8th in New York, and seats are very limited, so we do expect them to sell out, so make sure to click on the link in today's notes to get your ticket today. Right, let's move on to Jargon Busters. So we've 2 questions in this week. The first one is actually a combined question from 2 different users. So they asked, why are some companies listed on separate exchanges in different countries? Is there any difference in the stock on the different exchanges? And is there a foreign exchange risk in investing on these different stocks? A lot of questions there.
Yeah, so this is more commonly known as a dual listing.
Okay.
If there's 2 exchanges involved. And more typically you see a dual listing for multinational corporations who tend to list on their home exchange and then on one of the giant well-known exchanges, most usually NASDAQ or the New York Stock Exchange.
Yeah.
And, the way you'd reduce the overall concept to 2 words or 3 words is it increases window space.
Okay.
So if you take Vodafone, the telecoms giant, they're listed in London and they're listed on the New York Stock Exchange, and effectively it's the same business, and liquidity or shares are available on both of those exchanges, and therefore locals can invest in their local exchange, and that's just kind of, it's a window space thing.
Yeah.
So in order to be listed on more than one stock exchange, you need to meet the criteria of all the exchanges on which you are listed.
Yeah.
And generally the stock price on exchange A and exchange B will tightly follow each other.
Okay.
Not 100% overlap 100% of the time, but yes, they over the wider term they absolutely follow each other. On the question of foreign exchange risk, yeah, if you're going to buy shares on an exchange that isn't in your home currency, yes, you are carrying an exchange risk. The way I've dealt with that, because everything I've ever invested has been in US dollars. I have never earned US dollars. So over my life, I have taken what remained at the end of the month, converted to US dollars and bought shares.
Yeah.
But over the very long term, I'm an absolute believer that you will outinvest exchange rates, which over a very long term are cyclical.
Yeah.
But over the very long term, stock investments are not cyclical. They rise, they gain in value. So yes, you do carry a risk when you buy a foreign currency and invest it. And that's just, I suppose, it's another dynamic in your returns, but I certainly don't think, I've never expended any thought or energy as to what it actually means, because you'll buy a certain amount of dollars in today's money and you'll invest them, and that's where that investment should stay for years.
Okay.
Of course, the currency could also turn in your favour as well.
Oh, absolutely. And I've seen that effect too. You're dead right. And, the question of taxes then comes in, but I am not going to tackle that on this podcast. So,
Cool.
one exciting podcast that will be the question of international tax reconciliation. Brought to you by MyWallSt.
Right, moving on then. So recently, President Trump threatened to delist Chinese stocks from the US stock exchanges. So we have a lot of Chinese companies in our app, and one of our users asked Rory what would happen if these Chinese companies were delisted.
Yeah, so I'm not going to spend too much time on this because I think the actual chances of it happening are pretty much zero.
Yeah.
And I know what you're thinking. How can you be so sure with the White House that is currently operating? But firstly, the White House has come out and said that report was not true and that it's not going to happen.
Okay.
Secondly, my knowledge of financial regulation is not the best, so I stand to be corrected. But from what I've read, neither the president nor the SEC actually can delist a company from an exchange. That's down to the exchanges themselves, who can flag a company to the SEC, who can then approve a delisting. So they can't just kick a company off the list.
Them all off, yeah.
There's so much more. I like reading up on this. It's such a minefield of bizarre information, like the fact that if you're invested in Alibaba right now, technically you're not invested in a Chinese company. China doesn't allow foreign direct investment in their internet companies. What you're actually investing in is a kind of holding company that's based in the Cayman Islands that owns a bunch of shares in Alibaba. So they're called VIEs, variable interest entities. So we won't get into that. I mean, look, worst, I think, reading a couple of articles on it, I think the worst case scenario that would happen if they were delisted, which they won't be, would be that they'd continue to trade over the counter in the style of Tencent.
Yeah, I think the most important thing you said there is it's not something that's going to happen overnight either, or across the board. It's not. You're not going to wake up one morning and find all your stocks delisted.
I don't think it's going to happen at all. But yeah, I wouldn't.
I don't either, and I get President Trump's point, but really that I think is up there with kind of crocodiles in the moat. I don't think it's going to happen. Yeah,
there's a load of things that reading into this, there's an awful lot of things they do need to do with certain Chinese companies. There's a lot of backhanded tactics that smaller Chinese companies in particular use to get on the exchanges, which they definitely do need to crack down on.
Yeah.
But I don't see them taking Baidu, Alibaba, or any of those companies off the listings anytime soon.
Yeah.
Okay. Good. So let's move on then to our elevator pitch. So for this week's elevator pitch, I asked you guys to pick your favorite payments company. Emmett, I'll come to you first. What company do you want to pitch?
How long have I got?
How long do you want? 60 or 30?
I'll tell you what, I'll give you 15 seconds on what I nearly picked, and then I'll give you 15 seconds on what I actually picked. How about that?
You're getting 3 companies for the price of 2.
Well, the company I wanted to pitch was Square.
Okay.
Because simply I like what they've done, and I think they've done it very well. And about 6 weeks ago they reported, and they beat on earnings, but they missed total payments volume, which means that the volume of cash flowing through Square isn't what they anticipated. So that kind of goes into second place for me. And the stock I'm going to pick is MasterCard.
Yeah.
And it's simply because they earn a fee every time someone uses one of their 2.6 billion debit cards and credit cards. And it results in a massive tollgate business. The card processing fees and our ancillary businesses produced about 4 billion in revenue and 2 billion in profits in Q2 alone. So MasterCard's my pick.
MasterCard. Rory, your favourite payments company? You only get one.
Yeah, well, you're not getting three companies for two because I picked MasterCard as well.
Okay, but why do you like MasterCard?
Well, I mean, look, the boss has already said all the good points. No, look, I mean, payments is it's one of those spaces that is rapidly evolving. It's been doing so for the last decade now, but I still think it's such early days. I don't think we've even scratched the surface of what the internet and cloud-based applications in particular can do in this space. And the company I think that's going to do best out of that is MasterCard, simply because, between them and Visa, they have an unrivaled global network.
Yeah.
They, like you said, Emmett, they are a toll gate or a toll booth business. Whatever happens down the value chain, they're not really that concerned because they know eventually there is going to be money passing through that network.
Yeah.
And the reason I would go with MasterCard over Visa and over PayPal, even because I like PayPal as well, is because I think they have a real innovative-led culture. They're always trying to invest down the value chain and find places where they can improve and create value. They just invested or just acquired a Scandinavian company called Nets, which was their biggest acquisition in the last decade for 3.2 billion, which is one kind of a version of Venmo in the peer-to-peer kind of payment space. So yeah, I love the leadership. I love what they've done with that company over the last 20 years since it's gone public, and it's just look at the chart. There's not much else you can say.
It's had a small downturn over the last few weeks, which I guess if there's ever been it's at its June lows or something.
So that's a double endorsement of MasterCard. Can't get much better than that. So that's about it from this week's Stock Club. Don't forget about all the great new stuff in the My Wall Street app at the moment, and also if you're interested in InPerson Event in New York on November 8th, just visit the link in today's show notes. If there's anything you want us to discuss or explain on the next episode of Stock Club, please make sure to get in touch with Twitter. That's at MyWallStreetHQ, or email us at pod@mywallstreet.com. That's pod@mywallstreet.com. Don't forget to subscribe to Stock Club too, and if you're enjoying the podcast, please leave us a review on whatever player you listen to us on. That's about it from us here, so we'll talk to you in 2 weeks.